Hi, I'm Joe Guinan. I'm sitting here with market strategist Andy Busch, and we're going to ask him a few questions about what's going on in the economy and what's going on with Fed policy. Let's start with Fed policy. All eyes on the Fed now. We're expecting a rate move sometime soon. How soon and how much? What do you think we get?
Well, Joe, that's a great question because that's exactly what the market's trying to figure out. The central bank for the United States is probably the only central bank out there other than Brazil that's even contemplating raising rates. And the reason is because we've had strong economic growth. So that puts us in a very different place from, saying, the European Central Bank or the Bank of Japan or even the Bank of Canada. So that's interesting enough as it is. To me, what's fascinating about it is that we've been on this zero interest rate policy for a long period of time. So much so that the tools that the Fed uses to actually get off of zero interest rates may not work. And they've been spending a lot of time running around talking to guys in the market trying to figure out if they can do it through Fed funds, overnight reverse repos, and so on. So all of this is creating quite a churn in the financial markets. It's stalling the stock market up at these levels at 2,100. We seem to back away from there a lot. And the Fed is really clear in saying, we want to normalize rates, but we also want to stay data dependent. And we just don't want to stick to one plan. We want to let the data tell us where we should go, and we'll follow that.
So, best guess, when do we get a hike? And is it 25? Is it 50?
Yeah, I think the Fed will go in June, depending on what the data is. Now, I know the first quarter is going to be very weak. It's going to be below 1% as far as GDP goes. But just like last year, we should start to see a pickup as we get into the second quarter. We don't get massive snowstorms in Boston again. We don't have people jumping out the windows in Boston, jumping into the snow. So that'll be a good thing. And that's where the Fed will have to make a better decision. Also, the pickup really in economic growth in Europe has been good as well, and that may help the Fed decide to go 25 basis points. I think that's where they're going to go in June.
So 25 basis points in June. I agree, and I think that's the message they've telegraphed, especially if you look at the top three. The chairman, the vice chairman, and Mr. Dudley from the New York Fed, three voting in the top three. I think they've been pretty consistent in that message. So hopefully we get 25 in June, and the market will be prepared for that. I also think the second quarter could be, like last year, dramatically stronger. The cold and the snow, certainly in New England, really suppressed economic growth in the first quarter. Would you expect we get another jump in the second quarter as we did last year? New England this year not only has the pent-up demand for shopping, they also have an enormous amount of home repairs. After getting 8 feet of snow, everybody's got to go out now and get their house repaired.
Right, and then when it all melts, they'll probably have to get flood insurance, right? Sadly, I mean, I don't want to make a joke about it, but it's terrible, and that's exactly what will happen. So yeah, there'll probably be a pickup there. What's good too, not only from the United States, but outside of this country, we are starting to see these other central banks act to raise the level of growth. Specifically the European Central Bank. That's probably the best change that we've seen, so that should help. Also in China, they're changing things a little bit too to get economic growth going. So both of those things are very good, although exports from the United States are only about 13% of GDP. But I would say we also see wage growth starting to accelerate, and that's very, very good news. So overall for the GDP, I would expect for it to return to trend at least to 2.5% to 3% for the second quarter. It may get another percentage point pop as we come out of the first quarter into the second quarter, but it certainly will get us back to a lot of discussion about the Fed hiking in June.
Right. Now, after that initial hike, what do you think? You mentioned that Fed talks about being data dependent, and they want to get off the zero policy. So if they raise rates and they raise the range from, instead of 0 to 25, we go 25 to 50. Is that enough for them, or do they really want to get to some level higher than that? What do you think that level is? What do you think their timetable is? Do they want to get to 1% by the middle of 2016, or what do you think their plan really is?
Well, they are data dependent, but I know they want to normalize rates because this is just, first of all, they're no longer an emergency situation. So you got to take that off the table. And the Fed's Lacker and Lockhart have both said that in some of the discussions they've had recently. My guess is they would love to get to a nice round number like 1%, probably by the first quarter of 2016. That would be my guess if they want to really take their time with it. But Joe, really, if you take a step back from this, two things really stand out. First of all, there's going to be a lot of volatility. Actually, last fall, Janet Yellen warned us that this was coming, volatility. And we've seen it in the stock market, and we've seen it in the fixed income market. The second thing is that I would say we are changing the way that earnings are looked at by the market because we're changing the denominator on discounted cash flow models, right? You're starting to raise that number up, which means that the discounted cash flow that you get out into the future is worth less. And that's where the stock market is starting to struggle here. I think the Fed would like to raise rates to about 1% and see kind of what happens. I guess the major point I would take away is that the Fed has a long history of waiting way too long before they act, and then they rush to catch up when they're shocked to find out there's inflation. And that's coming. So maybe by mid-2016 they start to accelerate interest rate hikes.
Now, sometimes the market has this view that there's a Fed put. So if the stock market sells off enough, then that ties the Fed's hands and they can't raise rates. And they won't go to 25 or they won't go to 50 or they won't go to 1% because the stock market has sold off 5 or 8 or 9 or 11 or 13% or whatever. Do you think that model is still viable, or do you think that people banking on a Fed put is a bad trading decision?
Well, last year we were up, the S&P was up around 15%, the year before over 30%. I don't think the Fed has to worry about that anymore. I mean, there is volatility involved in there, and it is disruptive to the financial markets and to business because of that. But I don't think we're in the Bernanke put anymore. I think the Fed needs to really make it clear to the markets that they need to raise rates and normalize rates because it's dangerous if you don't. So I would say the S&P, to me, if we want to use a time frame that's analogous to I think what's going to happen here, I would say it's the 70s. I would say we're going to be in purgatory for a little while where we trade between like maybe 1900 and like 2100, 2200 because there's really no reason for us to go up dramatically unless the earnings substantiate it. And they may, but there's some headwinds there, obviously. But we're just, as far as I'm concerned, as far as the Fed goes, they're aware of that. They may make some commentary about it, but it is not going to be the driving force for them, of course, until you drop 500 points.
I agree with you. I believe the Fed put will be gone, but I also think there's potentially even more downside. I think 19 to 2100 is a little too narrow a band, and maybe they take out the bottom end of that band.
Like 1700. Yeah, it could potentially be there for sure. Smart guys like Joe Dahlia over at Bridgewater have said, hey, no, really, this is more like the 1930s. And he's very, very circumspect on what the S&P can do from here, maybe even thinking that it could drop over 30% from these levels if it's analogous to that time frame. I would say we're not in that time frame. We've changed so much. There are similarities. Certainly, the fiscal tightening that's gone on under the sequester has kind of represented a little bit of what happened during the 1930s as well. But I think this Fed is very, very aware of not only that time frame, but also under the Greenspan regime where we had those 17 rate hikes of 25 basis points each. I think this Fed will get to 1%. They'll tell everybody they're pausing for a while. Then maybe get to 1.5%, pause for like 6 months, because they really don't want to, hurt the stock market. They don't want to cause disruption, but they also don't want to just make it like we're going to inflate and see the wealth effect and cause inflation that way.
Yeah, I agree with you. I think 1937 is an unfair comparison, and I think he's got it wrong, and I agree with you. You mentioned the tools of the Fed, and they're concerned whether they have the proper tools to raise rates. And let's talk about that for a moment. The idea of going into the marketplace, doing reverse repos and pumping up the funds rate. I know there's been discussion around the Fed and in the marketplace about that topic. The level of excess reserves now compared to pre-crisis is dramatically higher. Somewhere around $3 trillion in excess reserves now, maybe $250 billion back in 2007. How much sopping up of this excess liquidity do you think has to be done in order to get the funds rate to move? So if they raise the rate that they pay banks from 25 basis points to 50 on their reserves, they also want to see the funds rate move from 11 to at least 36. To get that 25 basis point hike, they may have to sop up some of the liquidity. Do you have any sense of how much of that sopping up, how much reverse repos, how big that lever might have to be, and how problematic it will be? Certainly the Fed does not want to be in a position of trying to raise rates and finding out they cannot.
Right. Right. I mean, this is really what's exciting right now because the Fed has no idea, right? So let's start there. Let's talk about the Fed funds market because that's where they used to be able to raise interest rates and have the impact. It has shrunk to a quarter of what it used to be prior to the crisis because of the lack of use of it, right? There's no reason to use the Fed funds market if interest rates are at zero, right? So that's problematic for the Fed. This is why they've developed these overnight reverse repo markets and tested them and tried to go through it. But they are actually going around the country, having meetings, talking to people, asking this specific question because they don't know. My guess is it's north of $1 trillion they'll have to drain. So the thing that scares the bejesus out of the Federal Reserve is that they act to raise interest rates 25 basis points and nothing happens. That's where they will be signaling to the market that they've lost control and that the amount of excess reserves is so extraordinary that they can't control it. So that, to me, this is a wonderful question. I really don't have a good answer. I mean, $1 trillion maybe have to come out, but there's so many excess reserves. And it's funny because the Fed, under Bernanke and under Yellen, they all have said the same thing. Oh yeah, we can mop that up by different tools and levers that we can pull. They have no idea.
So let's just go there for a moment. Let's say they raise rates by, they raise the rate from 25 basis points to 50. They're hoping the funds rate moves. Let's say they sop $1 trillion out of the Fed funds market, and that moves Fed funds from 11 to 17. And in the days afterwards, Fed funds are at 17 basis points. They're taking $1 trillion out on a daily basis, but Fed funds are at 17. The Fed will obviously be concerned, do they just raise that number and then do $1.5 trillion, do $2 trillion? How do you think they react? Because clearly they want to move short-term interest rates, and my guess is they would just keep taking more and more money out until they got rates to move where they want them to move.
Right, so here's where the analogy between 1937 and today really comes into play. Because back in 1937, the Fed raised reserve requirements and raised them pretty substantially on the initial run. I think it was 4%, and nothing happened. And so they were like, well, this is okay, we can do it again. And so they raised it, basically, I think they went from 8 to 16%, if I remember correctly. That's when bad things started to happen. I think with this, we stand the risk of the Fed trying to sop up, nothing happening, right? They take $1 trillion out, and they go, oh, that wasn't enough. Then the next time they take $2 trillion out, and they go, oh, maybe that wasn't enough. And then the next time they act, maybe they really go full bore and take some crazy amount out. And then all of a sudden, the Fed funds rate doesn't go from 17 basis points to 25. It goes from 17 to 1.17 and then jumps, significantly because the market panics about how much lack of liquidity is there. So to me, that's where the risk runs and the volatility that will come in. It won't be the first one, won't be the second one, probably about the third or fourth one where people go, oh, they're serious this time, and the Fed overreaches. So to me, that's where some big risk is.
So all this will be likely sorted out in the early days, within a week or 2 weeks or 3 weeks after they make the adjustment.
It could be. I mean, again, it depends, as you said, if the market doesn't react, then we've got a real fun game going on here, and when the Fed will go, oh, we need to do more, because that's really where they'll make their mistakes.
Just want to comment a little bit, or hear your comment a little bit on the global economy. We have this dramatic price drop in oil, and two of the biggest oil importers are Japan and Germany. Two of the economies we would most like to stimulate would be Japan and Germany. So isn't this sort of a perfect confluence of events? The drop in oil, Germany and Japan will get an economic boost, and that will help the world right where we want the world being helped. Instead of just U.S. growth pulling the whole world up, this oil price drop should help Germany and Japan recover substantially. Is that overreaching, or what do you think?
Well, let's look at who are the big oil importers, big energy importers. You mentioned Japan. Obviously, ever since the nuclear accident there, they've been drawing in coal and liquefied natural gas, whatever they can get their hands on. China's another big importer of energy, and so's India. India's been really, if you look at their stock market, they've been doing really well under the new Prime Minister Modi. A lot of that has to come with anticipation of changes there, but also that dramatic drop in price is like a tax cut for everybody. It's especially helpful for the middle income guys because they spend more of their money, more of their disposable income on energy and things like that. So for that large group, it's fantastic. You're starting to see their spending go up, and that's very, very helpful, not only in the United States, but also in parts of Europe too, where they haven't taxed energy to the nth degree. We all know that their gasoline or petrol prices are so much higher than they are in the United States because of those taxes. But also in places like Japan. So these are good things. It's almost like a global targeted tax cut to help middle income consumers, which is fantastic. Now it's a question of how long we stay at these levels, but I really believe that even with the number of shale rigs that are coming off, this is a much different game than what we've experienced before with oil, because we have seen the world shift from the Middle East as far as being really the swing producer. Saudi Arabia still is. They can flip a switch and pump more. But now, in the United States, we pull these rigs off, but within 6 months we can get about half a million barrels per day back online, and within a year we can get 1.5 million barrels per day back online. So it's much more like a mining effort than it is an oil production effort. It doesn't take as long to get it going. So that's the good news. So I don't see, or I don't foresee, oil going back above $80 anytime soon unless the entire Middle East blows up, and I don't expect that to happen. So we're probably in a broader range of maybe 35 to like 65 for a little while here. But great point. Yeah, I think it's wonderful for those economies, and they'll continue to benefit from it.
Yeah, and I agree with you on the outlook for oil price. I think that's the wide range. Andy, I want to ask you a little bit about the U.S. domestic economy. It's interesting the sort of change in events we've had this year. We see corporate profits softening a little bit. So maybe corporate America has already run full gamut. And yet we see the consumer maybe better positioned than ever. Household balance sheets, consumer balance sheets are in good shape. Employment is doing really well. How do you see this playing out for the U.S. economy, let's say for the balance of 2015 and 16? Do you think that we continue to see strong employment gains even though corporate America is a little bit less profitable or less profit growth? Or do you think the slowdown in profit growth hurts employment? Where do you see that playing out?
Well, I think the growth in employment will hurt corporate earnings because they're going to have to pay more for these new employees to get X amount of new sales, right? They're bringing people in because things are growing, but when you do that, your labor costs go up. So you may not see it translate into earnings right away. Also, the slowdown in Europe and China has really impacted a lot of companies. I think half of the S&P 500 gets their earnings from exports, right? So we know that those companies have been hurt. And also what's interesting too is the dollar. The US dollar has really strengthened. It's strengthened 20% over the last year. And that's hurt, again, exporters who are sending stuff overseas, made their products more expensive overall. So we know earnings are getting hit. And then just finally, also with the Fed raising rates, as I've mentioned, and your discounted cash flow models, your denominator is getting bigger. So that means your values out in the future are getting less, and so people start to retrench what they think those values are and what their worth is. So overall, it's really a question. We got up to about 18 times earnings on the S&P recently. We've kind of backed away from that a little bit. So looking into 2015, you look at earnings, they're going to start pretty soft in this first quarter. We know that because of some of the weather-related issues. It will be fascinating to see as we get through these earnings. Again, it's not exactly what the earnings are, but it's what the guidance of these companies are telling us for the rest of the year. If those are still pretty good, then the stock market will hold these levels. If they're really opaque and really kind of like misty, I don't know what's out there, that would worry me more, and I think that's when you'd start to see the stock market back off.
Mm-hmm. So you'd expect to see payroll numbers continue to be fairly strong?
Yeah, somewhere over 200,000, 250,000.
Okay. And we've seen some of that hint you've talked about with wage inflation. We saw the port people out in California. They must have got a wage increase. The steel workers down at the refineries, they must have got a wage increase. Certainly, I think the biggest employer in the U.S., Walmart, and their wage hike.
Right, and TJ Maxx and a lot of these retailers are increasing the average hourly earnings because they're raising minimum wage.
So those have all been announcements in the past few months, but those numbers haven't necessarily flowed through yet. So we'll probably start to see those results in hourly earnings as the year progresses.
Right, so CPI is only running right now at below 2%, right? But if you strip out energy, it's closer to 3%. And that's to me, what's fascinating. So the Fed really, getting back to the Federal Reserve, what we talked about earlier, is like they actually have a pretty compelling case to start raising rates. They say inflation is below 2%. It is. But when we get these year-over-year numbers start to kick in towards the end of the year, we know we're going to start seeing faster inflation because oil will be, coming from much, much lower levels, and as will gasoline prices. So the best news I could say is that consumer confidence is holding up pretty strongly, and that's really great. And it's staying in the 90s. That's fantastic. I don't know. For me, it's difficult to look into the future. Everything's kind of a little bit muddy right now, but I would say we're in a good place. It's not great, and it hasn't been. I'd like to see some progress made in Congress on a few things. I'd like to see them pass some budgets. I'd like to see some certainty for tax policy overall. That would help the economy as well. So there's definitely some things out there that could further help the U.S. economy.
You mentioned inflation, and it's interesting because some people at the Fed and some outside the Fed have mentioned waiting until you actually have inflation to raise rates. If you wait until you have inflation, with the substantial easing that we have to withdraw from the monetary system, not only the raising of the rates, but also the $4 trillion expansion in the Fed portfolio since pre-crisis, that's probably a 5 to 7 year period of time to pull all that monetary stimulus out. And
Right.
If you wait until inflation starts, you're really in trouble. I'm more in the camp that thinks we already might have waited too long, and we might already be chasing the market, as you say, by the fall when you see an uptick in inflation numbers.
Definitely. Well, we're here in Advantage Futures offices, and we're literally across the street from the biggest dove on the planet, which is Charlie Evans, Chicago Fed president. Now, he has been a huge advocate to allow the inflation rate to go at least a percentage point above where their normal target is, so from 2% to 3%. What I would say is I agree with what you're saying. I think by the time you wait to see the whites of the eyes of inflation, you've already lost the game. And I think, especially because of what you delineated there of the massive amount of balance sheet, which they can only allow to roll off, because remember, if they start to sell it into a bad market, they're going to lose money. So that's a dangerous thing. And then of all these excess bank reserves, they've never encountered any of this stuff before. And I just got to keep hammering that point home. The Fed may say that they're in control, but that's all marketing.
Right.
They have no idea, because they don't know how the market's going to react. So it's a dangerous time, because my guess is they'll make some serious mistakes, and then they'll rush to catch up, and then they'll back away. It's going to be volatile for a long period of time.
With regard to the Fed's portfolio, they raise rates to 1.5%. At what point in time do they decide to start letting their portfolio wind off? I know they have a big bulge in their portfolio maturing in 15, 16, 17. Obviously, right now they're rolling over all their investments. At what point do you think they might start to let their portfolio run off and by that manner sop some money out of the system?
Right, when they raise rates and they don't get a reaction is when they'll likely stop rolling over their balance sheet and just let it to slowly roll off and allow some of that to go back into the system. And I think that's really the key. The Fed they do have a lot of levers, but if they fail on raising rates, right, when the market doesn't move, then they'll try to pull a lot of different things. Overnight repos is one, Fed funds is one, and then also letting their balance sheet roll off.
And that's all dependent on continued strong economic growth.
Mm-hmm.
So if we have strong economic growth, we spend the next year getting rates up to 1.5%, and then sometime in 2016 they start letting their portfolio decrease in size from 4.6 trillion, maybe come down by a few $100 billion per year. Well, thank you very much. This is Andy Busch, market strategist. I'm Joe Guinan from Advantage Futures. Please visit our website at advantagefutures.com. Thank you.